I'm going to show you a powerful loan that has the ability to save you tens of thousands of dollars in interest. The loan is called the All-in-One Loan. It's a proprietary product by the lender CMG. I'm running a simulator in this video, and I have pre-entered some pieces of information for the sake of time. We're assuming that we're doing a purchase loan. We can also do a refinance with this program. We're assuming it's an owner-occupied primary residence. This loan works on a secondary home or investment property as well. We are comparing this loan to a traditional mortgage. In a refinance scenario, we will compare it to an existing mortgage. We're assuming the home value to be at 1.5 million, 20% down. So the loan balance is at 1.2 million. We're comparing this to a 30-year fixed mortgage at 6.5% rate, which is the average in the current rate environment. And we're assuming an $18,000 in income. This could be from your paycheck or from your business. We're just assuming that we're putting in $18,000 per month as income. And as you can see, your traditional mortgage, your payment is about $7,500, and your property tax and insurance is about $1,800. We're assuming that your monthly expenses, like for groceries, car loans, cable bills, gas, food, is around $4,000. So we subtract all of your expenses, your mortgage, property tax, insurance, monthly living expenses from your $18,000 income, and we get $4,500 left over. And this is your disposable income. This is actually a key piece to this loan. And let's go to the results here. So you can see on the left-hand side is our all-in-one loan. On the right-hand side is our comparison loan, the 30-year fixed mortgage. You can see that the all-in-one loan pays off your 1.2 million loan balance in half of the time. In 15 years, it'll pay it off. And you are going to be paying $1 million in interest payment for 1.2 million borrowed with the all-in-one loan. In the traditional mortgage, you will be paying 1.5 million in interest payment for 1.2 million dollars borrowed. So your savings with the all-in-one loan is over $470,000. So you're probably wondering, how does this work? What is the trick? There are several key features that differentiates the all-in-one loan from a traditional mortgage. It actually combines your checking account and mortgage account into one account. It also calculates interest using simple interest calculation. Lastly, the interest payment portion is separate from the principal payment portion. Let's look at an even simpler example. Suppose you only borrow 100K, and suppose your monthly paycheck is 10K. Further, you deposit your paycheck on day one of the month. Remember, our mortgage account and checking account is one the same account. On day one, when the paycheck goes into the checking account, immediately it brought down the 100K loan balance to 90K. And suppose on day 15, you spend the entire paycheck. Then the combined account shows a loan balance back at 100K. Now, when interest is calculated, it calculates daily on the account balance of that day, and it adds up to 30 days, so it becomes your monthly interest. In our example, for day 1 to day 15, it calculates at 90K. For day 16 to day 30, it calculates at 100K. This makes sense because we don't spend all of our income all at once and right away. Some bills are weekly, like groceries. Some bills are monthly, like phone bills. Some are twice a year, like property tax. So for a lot of us, we have this idle money sitting in the account waiting to be spent. The all-in-one loan takes advantage of this fact and puts our idle money to work by lowering our interests. I mentioned previously that your interest payment is separate from your principal payment. This is gigantic. It means now you get to apply your principal payment 100% towards your loan balance from day one. The trick to a lower interest cost mortgage is to lower the principal balance as fast as possible and pay it off sooner. Have you ever looked at an amortization schedule of a traditional mortgage closely? I have actually a screen here where I Googled any mortgage calculator online, and I'm running the same numbers from our scenario on this mortgage calculator. So the home values is 1.5 million, 20% down, 1.2 million in loan amount at 6.5% rate. You see here that there is a giant monthly payment of $8,700. It is comprised of interest, principal, tax, and insurance. On year one, notice your interest portion of the $8,700 monthly payment is actually 6 times as much as your principal portion. If we fast forward 10 years, in year 2034, your interest portion of the monthly payment is still 3 times as much as your principal portion. And your loan balance is still sitting at above 1 million. What is happening here? Essentially, banks want you to pay the entire interest cost of a 30-year term loan in the first 10-15 years by preloading your payment with interest before they will apply your payment to go towards your principal. Our all-in-one loan doesn't do that. It separates the interest from principal into 2 payments. It allows your payment to decrease principal 100% on day one. And we know that the lower the principal, the lower the interest. So you are no longer front-loaded with 30 years of interest to pay first. And this is another reason you see the gigantic savings in interest cost of the all-in-one loan. Several more features I want to point out here. In our scenario, on average, you pay down your principal at 6.4% annually. That's twice as fast when you compare it to the traditional 30-year mortgage. One interesting feature to point out is the all-in-one loan is a HELOC. That just means whatever amount you have paid into the principal, you can take it out and reuse it anytime. With a traditional mortgage, you can't do that. Your equity in the house or whatever you have put into the principal cannot be taken out without a refinance. With the all-in-one loan, however, you can take it out anytime and use it towards that vacation or investment property if you want to do it. Also, notice the cost of the borrowing, which is for every $100 borrowed, you're paying $87 in interest in the all-in-one loan. In the traditional mortgage, you're paying 40% higher in the interest cost of the loan. You're paying $127 for every $100 you borrow. And a little further down, you notice that it'll take the equivalent of a traditional mortgage at a rate of 4.7% in order for it to match the all-in-one loan in terms of interest cost, and which we know in today's environment this is not possible. Or in other words, it'll take the equivalent of an all-in-one loan at 10.39% in interest rate to match the traditional mortgage. So you're probably wondering, what is the rate that this scenario is being run on? So I'm going to show it to you here. I used 9.19%, which is the ceiling rate. It cannot get higher than this currently. So this is the absolute worst case scenario and the highest rate possible. If we actually use the par rate at 3.5% margin, the rate goes down to 8.69, and the results are even better. So you can see that we have just decreased our payoff by one more year down to 14 years. And we have just increased our interest savings to $600,000. So you can see that with the lower rate, this is even more powerful. Of course, your numbers will be different from what I used. I will be happy to run the simulation with you and play around to show you all the features and what your savings look like. Feel free to reach out to me.